So, broad dollar strength, that seems to be persisting. You got to wonder whether that can go on, given where we are beginning to see some cracks.
Yeah, absolutely. So it's all about CPI now. The Fed minutes, very clearly, Fed are back focused on inflation. It's actually not level of inflation, it's the pace of the decline in inflation. Most Fed members want to see it coming down more quickly. What does that mean? That means more tightening. Interestingly enough, we're a little bit counter consensus on this. We think that inflation is going to be weaker than expected. Currently, I think the consensus is around 0.3 for the month. We actually think it will hover around the 0.2. If you get sequential 0.2s, yeah, look, in the end, we think July hike is done and dusted. We think we get the 25 basis points. That's certainly what's in the price. But I think the trick now is to work out what Fed hawkishness, at least in the chatter, is versus what they actually do from there. And clearly the market will be now, after this hike, or potentially this hike in July, they will be clearly focused on, okay, what's the Fed's next step? Is it flatline for a while? Is it down by the end of the year? We actually think that we still could get a cut in December. After the minutes, that felt a little bit more like it was going to be more of a start of the year easing of policy, but we still think there is potentially a cut at the end of the year, and that will change a lot of these dollar dynamics that are going on currently.
But why aren't you yet convinced? You know, the Fed has said time and time again that we are not cutting this year. Why are you not buying into the Fed narrative?
Yeah, from our perspective, we still, the macro data has taken longer to come under pressure, particularly on the consumer side. Housing has still held up pretty well, to be honest. The industrial side of the economy has been particularly weak. And we think that that continues to be relatively weak going forward over the next month or so. But the consumer side, we think, will come under pressure from tighter lending standards, a bit of a hangover from Silicon Valley Bank, but also the tighter conditions that are going on there. So we think that additional tightening of 25 basis points plus the credit tightening that's going on will start to bring consumer under pressure. Yeah.
Wayne, David here. So we're talking about this now. Well, yields, are, to your point, are still quite, let's put it, juicy, let's put it that way. In some parts of the world, I mean, take a look, LATAM, parts of Asia, for example. What do you think is the most attractive now as far as carry?
Yeah, look, I think that, you know, we were probably a little bit early on this because the dollar has been taking a little bit more time to demonstrate the dynamics that we sort of just talked about, but definitely India, Indonesia, these currencies have held up. These currencies, at least in Indonesia's context, have done very well relative to the pressure they've been under, particularly with respect to the aggressiveness of the Fed hikes. Traditionally, the rupiah has come under more pressure as a result. But rupiah offer very good carry, particularly with the Fed on pause. Even that be the case, historically, if you look at two-year yields in the US, the Fed can be on pause and two-year yields will start to bleed lower. And I think that's sufficient to start to see people want to chase carry in currency. And a lot of these structural stories that, you know, we most preferred on India, we see a lot of structural positives for Indonesia, and we think these structural stories are going to support investment and therefore support these currencies going forward.